Hey guys, it is showtime. It's good to be back with you this week. Hopefully, your week has been pretty good. Today was a little bit volatile, right? It was when I actually put this slide together, which is this one right here. When I put this slide together for tonight's broadcast, there was a lot of uncertainty in the air, and we so I thought, man, it'd be a great time to talk about uncertainty and opportunity. And it is a great time always to talk about that. So we are going to chat about it. But what started out to be markets down over 1% starting out the day, they ended up kind of turning around. So it was a bit of nothing burger. But hey, anyway, we're going to talk about stocks tonight, and that's what we enjoy doing. So regardless of whether the market goes down or goes up, we are going to talk about stocks. So let's chat just a little bit before we get started. And let me pull this back up about where the portfolio was. And again, the brokerage that I use doesn't update the performance statistics until sometime overnight. So the best I can do is through Friday of last week. That would be 227. February 27th. So as you can see, maybe you can't see, maybe I should make this a little bigger. How's that? Ooh, that is much better. Not really. You can't see there we go. I think that'll work. As you can see, we are the green line in the chart. And so we're beating the S&P, we're beating NASDAQ, and we're beating Dow Jones. We are not, however, beating the Russell 2000, which has just been killing it. I say that. I say they've been killing it. They killed it the first 2 weeks of the year, from January the 3rd or whatever that is until like the 16th. And then they have been a bit descending over that time. If we were to draw a line between their peak and where they are now, they're in a descending pattern. Whereas if you look at this green line, which is our portfolio, it is in an ascending pattern. And that's the way we like it. We like to just make money all the time. So anyway, so there's that. And then, we go over to the numbers themselves. And you can see that on a year-to-date basis through February 27th, we are up 3.57%. For the week, we were down a couple of tenths of a percent. But if you look at some of these other things, look at that S&P 500 total return down. Well, it's up 0.68% on the year, but it was down 11 and 32, over 0.4% last week. Check out the NASDAQ, down almost a whole percentage point. That'd be 100 basis points almost. Dow Jones was down for the week by like 1.3%. Russell 2000 was down 1.2%. Our portfolio for the week, our portfolio is down only 0.2%. So we love to see our stocks go up, but I also love to see them not go down as much as the market when things aren't going our way. So from a risk-adjusted perspective, we are still doing very well. We are well outperforming the S&P 500, NASDAQ, and Dow Jones Industrial. And on a risk-adjusted basis, we are outperforming the Russell 2000. So that's good to know. That's just a little piece of information. Now let's flip over real quick to Snowball Analytics. This might be a little small as well. Let's see if we can't grow that a little bit. So this first chart is the portfolio value on a year-to-date basis. And as you can tell, the green line is the Russell 2000. And if we were invested in the Russell 2000, we would be $60,000 higher as a portfolio value. If we were invested in the NASDAQ 100, we would be $80,000 less in total portfolio value. So we are beating the Nasdaq this year by over $80,000. We're beating the S&P by over $47,000. So I'm pretty tickled about that. Let's see if there's anything else cool here. I think all that pretty much says the same thing. Let's look at if I can find it now. See if it's where's it at? I always get lost in here, and maybe that's something I should share with them. Let's do this real quick while I'm here. You can see here which stocks individually that were up or down year to date, and it's no surprise, right? Lockheed Martin and Northrop Grumman are two of the largest growths that we have. One is 40%. Lockheed Martin's up 40%. Northrop Grumman's up 35%. Hershey's up 30%. EOG's up 23. Carlisle's up 23. Hess is up 17. RTX is up 16. So we've got some stocks that are really doing well, but then we got some offsets, right? So Intuit, we're still down about 24% on Intuit. We're down about 23% on Cormetics. Microsoft, believe it or not, is down 17% on the year. Visa down 8.6, T. Rose down 2.2, and Google down 1.4. So you put all that together and you end up with a gain on the year of what does it say? 3.68% here. So not bad. Diversification. I don't think that's where this is. No. I'm looking for the risks. Anybody know where those are in Snowball Analytics? Holdings, transactions. I don't think so. Dividends, growth, metrics, maybe? Let's try that. There it is. Here's our volatility right here. There's two measures that they use. One measure is called the Sharpe ratio. The Sharpe ratio looks at the standard deviation of the portfolio that includes gains and losses. So whichever way it moves, it counts it as a standard deviation. Our portfolio is doing well. We are at 1.13 on the Sharpe ratio, which is good. You want that number to be higher because you can see the little frowny face on the left and the big sunglasses on the right. So the closer you get to the sunglasses, the cooler it is. Then we got, Russell 2000 is way down. NASDAQ is around 0.789, and the S&P 500 is 0.982. We are 1.131, so we're doing well. Now we've dropped back down a little bit on the Sortino ratio, but we're still killing the markets. It doesn't like it, or it says it requires attention if it's below 2, but we are 1.841. S&P 500 is 1.571. Again, lower is worse in this category. NASDAQ, 1.267. Russell 2000 is 0.529. So we're killing it on a risk-adjusted basis. So, really happy about all that. And so with that, we're going to kind of get talking about stocks. Let's do that. I thought I would share with you guys today. Let's see who's all on today. Let me know if you're out there in Never Never Land. There, I'll take this off the screen. We got Bernard here. Good to see you, man. What's your thoughts on I think he says PFG. Let me write that down. We'll take a look at that. So here's my hey, Rust is here. Good to see you, Nathan. All right, man. So we're going to take the portfolio here, the spreadsheet, my model, and we're going to look at It was gonna be a lot more interesting, I think, when, things were really going crazy, because here's a thought. When we're in the stock market and things are going crazy, that means people are making some irrational decisions, and it's a lot easier at that point to find those irrational decisions, buying into those stocks, and letting rationality come back, and then, good things happen to us. If we had done that early this morning, we would have done pretty well. But who would have thunk it, right? Um, let's go to our stock listing here. Well, you can see we were up 0.18 on the day. S&P was up 0.04, Dow was down 0.15, and the Nasdaq was up 0.36. That's interesting. All right. Let's take a look at our stock listing here. So this is the model that I use that kind of ranks stocks in a descending order, that tells me where, if I wanted to put the next dollar to work, what would be the best bang for my buck? What would be the best stock to buy? Right now, at the top of that list is ServiceNow. Now, ServiceNow does not pay a dividend. It is one of those service as a software as a service, a SaaS business, and it, along with Intuit, is suffering from what they call the AI, what I call the AI doldrums, right? So there is a thought that AI will replace the value that is brought by companies like ServiceNow and Intuit. Um, I think that's a bit misplaced. This is just my opinion. I'm not asking anybody to invest in anything. I think that's a bit misplaced. I think AI is going to help them become more efficient, but I don't think that they're. I don't think it's going to replace it. So let me take a drink of my orange Mio flavored water. I ran out of my allergy pills, and I think it's beginning to catch up with me. So I got to pick some of those up tomorrow. Yeah, Fast Eddie, I think you're right, man. I think it's the AI hangover. So that's what we have is ServiceNow is at the top of the list. I haven't determined to buy anything. You can see the holdings I have in ServiceNow are 0%. The next stock on the list, believe it or not, is Amphenol. Now, Amphenol went down over 7% today, which is one of the reasons my portfolio took a hit, because it's over 5% of the portfolio. Although it didn't take a hit, it just didn't grow as much as it could have. So yeah, Amphenol is down, but the model says it's a great buy. I'm looking at like a 31% return from here to next year. Analysts are saying 26% return. So I'm not in bad company here. If I didn't already hit the limit on my holdings there, 5% is kind of the limit for me, then I would probably buy some more here of Amphenol. It is a wide moat. It's about a 20% discount off of its fair value. Runs about a 16% return on invested capital. Medium uncertainty, which is kind of nice, right? It's not a real volatile stock, or it's not a real volatile company. The stock can move around pretty big. Dividend safety rating is an 87, which tells you the financials look pretty good. And then the payout ratio is only 22%. So if you're looking for a high yield company, this is not your company. It is a 0.7% dividend yield. But here's another metric I've been kind of toying with. I want to get you guys' thoughts on this. I've been toying around with this week. So if I've got a payout ratio, or if a company, let's just use Amphenol as an example. If Amphenol has a payout ratio of 22%, that means it gets to keep 78% of its earnings in the business. It pays out 22%, it keeps 78%. if we can then say that Amphenol is going to get its return on capital of 16% on the additional capital of 78%, that tells me that so if I were to take 78%, let me just do that on my phone so it'll be accurate. I was going to do it in my head, but then I might lose everybody. So 78% of the earnings at a 16% return equals, that means that I should expect the earnings of the company, if nothing else, I should expect the earnings of the company to drive an additional 12.5%. Here. Can you see that? An additional 12.5% to the bottom line, just in the incremental capital that they're able to invest in the earnings of the company from this year that they keep for next year. Does that make sense? And so, if I can expect 12.5% just from growth, then I got a little bit in dividends, and then they're 20% below value. That's not a bad deal, right? What do you guys think about that metric? And let me know if that didn't make any sense either. So that would be helpful. Okay, so Amphenol is kind of up there near the top, and Whirlpool, believe it or not, has made its way back to the top. I am not interested at this point in owning Whirlpool. I might even pull them out of the spreadsheet, but they don't have a moat. Analysts are saying they're going to grow by 44%. I don't buy that, but the model says 29, so they are at half of their fair value. But their return on capital is only 6%. They've got a high uncertainty rating, which I agree with. I think that is very true. But here's the kicker. There's two kickers here. One is their dividend safety rating is only 40. That is a very speculative type of dividend. And then their payout ratio is 85%. That means that they're paying out 85 cents of every dollar that they make. They are paying it back out. And so anyway, I'm just not really loving Whirlpool at the moment. Now the next one is Comfort Systems. So the model says we're gonna, if we invested in that, we should expect about a 29% return over the next year. Analysts are saying about 18%. The thing that scares me away from Comfort Systems is that they are about 140% of their fair value. With it being that high, I don't know that I'm interested in that. They've got tremendous growth. Their payout ratio is only 7%. They got an 80 dividend safety rating. Return on capital is 35%. They're smoking, right? So let's do that same exercise. If the payout ratio is 7%, that means they're paying out to shareholders only 7% of what they earned last year. So 93% of that capital gets to go back into the business if they can get the 35% return. That's pretty high. And investors are paying up for that because they're willing to drive the share price up well above its fair value. So that's the thing that kind of scares me away from it. I don't know. I mean, I'm not going to buy it with that level of above value. So, but it looks very interesting. It looks like it does have some room to move. The next one somebody gave to me last week. If you were on the program last week and you gave me this, let me know. It's called FactSet Research Systems, FDS. I looked into that a little bit more. I am liking that business. My model says a 24% potential return. Analysts are saying 41%. It's a narrow moat, not a wide moat, but it's a narrow moat. It's at 61% of its fair value, which means it's 39% off of its fair value. Return on invested capital is a healthy 16%. medium uncertainty, which is good, and then dividend safety is 95. So that is good. And then they have a 25 percent payout ratio. So that, I mean, the financials on FactSet research look really good. The challenge, I think, for me is that I also I believe that FactSet also has this AI hangover thing going on. So you have AI hangover for ServiceNow, you have AI hangover for FactSet, you have AI hangover for Intuit. Now I am already at about 2.5% on Intuit. So, I don't know. Maybe I spread that risk around a little bit and hit me up some FactSet for another 2.5%. Potentially potentially invest in both of those companies, realizing that they're suffering from very similar issues in the market. So the question is, does the market have it right, or are we missing something? Now, FactSet is down like 50% over the last year. It's down 25% roughly this year to date. So but everything's worth something, right? And so what is it worth, and am I willing to invest in it? I need to do a little bit more research on it. Looks like they have some proprietary data models that are used by hedge funds and investors, around the world. They don't have a tremendous amount of growth. They're growing about 5 to 6% in their average subscription volume. So, but their margins are like 30 something percent. So it's very profitable business. Is AI going to, push them out of the way? I don't know. I don't know what the answer is, but that's why it ranks so high, is that nobody else does either. And so investors typically will take the worst case scenario. And so I think FactSet falls into that. So I'm looking at FactSet pretty closely. I wouldn't be surprised if I dabble. Is that the right word? Dabble a little bit in FactSet. Broadcom is also up there. It is a wide moat, about 34% discount to its fair value, about a 14% return on capital. It is a high uncertainty rating, which I also agree with. Dividend safety rating of 67 and a payout ratio of 35%. But it's still a reasonable looking investment. So I'm going to look at them as well. Although my strategy for chips, semiconductors, has been to buy an ETF. So I probably own some Broadcom already as a part of the ETF. I use SOX, SOXX as the ETF. You could use SOXQ, probably has a better expense ratio, but that's what I usually do. And so if I do venture into the individual stocks in the semiconductor space, Broadcom right now is up at the top. Microsoft is another one that if I did not own about 5% of it, I would buy more. I think Microsoft is going to do very well in the future. Then we have automatic data processing, ADP, which I don't own, but they have, some similar issues, right, to this AI hangover. So we're seeing a lot of companies, and then Intuit's right below that. Accenture is right below, that. So we're seeing a lot of companies, ServiceNow, FactSet, ADP, Intuit. A lot of those companies are the ones kind of floating to the top of our model, which tells us that the market is expecting these companies to be significantly impacted by this AI issue. So the question we have is that true? Are we going to actually run into that? And if it is, then we should not buy it, right? But if it's not, then the market's kind of giving us a deal right now on these stocks. So something to think about, something to consider. It's something I'm considering. So let's kind of see what you guys have on your plate. Fast Eddie's been kind of hanging out there with the AI hangover for the last 15 minutes. Let's see what you guys have on your list. Somebody wanted me to look up PFG, and that was Bernard. So we'll take a look at that. Let's see what we got here. Rust has been DCAing slightly more into APH the past few weeks. Yeah. I mean, especially after today, man, it's down almost 7.5%. I don't think that's a bad move at all. I think for the long term, APH is it could be a winner. So we'll just have to see, right? Proof's in the pudding. It's interesting to see Fix as number 5. Yeah, that's right. That's right. It's 22% of the portfolio. Yeah, you're up 290%. Yeah, I mean, it has been smoking, man. It is my model has been saying buy it, buy it, buy it. I've been like, no, it's too risky, it's overvalued. So I've kind of lost out on that just because I didn't trust the model. But it's still saying buy, so I don't know, Let's see. Check out GLW. That is Corning, Corning. So we'll check that out. GLW. They've been doing, I think, pretty well. So hey, Michael, it's good to see you, man. I didn't say hello. I just read your comment. Let's see what Fast Eddie has to say. Market positioning. FactSet's subscription-based model offers sticky client relationships. So does my honey. The honey for my bees. It offers some sticky relationships. Sorry, that's a dad joke. And consistent revenue, positioning it well for long-term returns despite recent market pressures. Yeah, I think that's right, Fast Eddie. The only challenge I think for FactSet is, I mean, it's a slow growth business. It is sticky. I mean, that is where its moat comes from, right? That means that it can continue to grow, within its family there. But where's it going to get its growth from outside of its current customers? Is it going to, offer some new product? Is it going to, offer additional value that customers are willing to pay for? That's the challenge for me, is that how fast does it grow? But you know what? Hey, here's the thing, man. Take a look at this. I'll just share this with you. This is what I was thinking about earlier. Not that you care, but I'll share it with you. FactSet, take a look at this. Where are we going to go? We're going to go way over here in the model. And we're going to find this. We're going to see that the model is expecting about a 16% return of fair value, meaning that it is more of a value investment than it is anything else. So it's got a 2% yield. It's got a growth of about 6%. So we should expect them to pay us 2%. We should expect the business to grow intrinsically or organically, I guess is the right word, by 5.8%. And it's currently trading at a discount, so we should expect some of that value to come back. So I think FactSet, different from Intuit. Intuit is a growth play, but FactSet for me would be a value play. So maybe I'm arguing against myself here that maybe I shouldn't be looking at the growth and shouldn't be worried about the growth because I'm buying it for the undervaluation. So maybe that's the way to look at it. Thanks, Fast Eddie. I appreciate you helping me through that. Let's see. Yeah, Michael, I agree with you, man. You made a great call on Texas Pacific Land Corp, TPL. Yeah, that's good stuff, man. I wish I had dipped my toe in that water, but I didn't. All right, so somebody wanted to look at PFG. So let's take a look at that. Let's see what's happening with PFG. Gee whiz. All right, PFG. Let's take a look here. So let's go to Simply Safe Dividends because they have a lot of information that's really concentrated. Principal Financial Group, life and health insurance, super exciting business. Folks are just dying to get into that business. I'm sorry, I shouldn't say that. All right, they got a dividend yield of 3.34%. I haven't looked at this company before, so I'm going to take a minute here and kind of walk you through how I look at companies just on a first glance. Dividend safety is a 72. It's got a nice credit rating at A minus. Let's move down a little bit here. They've got a payout ratio in the mid 30% range, so that's pretty decent. They have an average growth rate in their dividend of 6.6%. So they've got a nice, steady Eddie growth pattern here on their dividend. Now let's take a look at their earnings payout ratio. And we can see that's pretty steady, flat. And that's kind of the way we like it. Because what that tells us is they are growing the dividends at roughly the rate that the business itself is growing, and that's what we like. We like that growth. So we can pretty much count on a growth rate of around 6 to 7% just in growing the business. So that's good. Plus, they've got a what do we say, a 3.5% dividend. So we're looking at a 10% consistent returner just in business growth and dividend payouts. So that's not terrible, right? I target 8% growth per year, so that's certainly a stock that I would partially be interested in. But let's take a look at its valuation. Oh, it's not valued. So Morningstar doesn't value it, but it does say it's pretty much fair valued. So I would say this is a 10% growth stock, 10% return stock. I think that's a pretty reasonable assumption on that. Let's see if there's anything else here that we care about. Earnings can, they're pretty consistently growing. Share buybacks, a lot of those. Sales are pretty flat. Return on invested capital is pretty low. That's one thing that I do like to look for is some return on invested capital. 6% means that they're getting return. So if they invest $1, they're getting about 6 cents on that. Now, that doesn't mean that every dollar they invest, they get 6 cents back on, but on average of their whole total capital structure, that's the way it's working. Operating margin's pretty low, 9%. Net debt to capital is really low. That's nice. And they have their debt might be so low that they don't have an interest coverage ratio. But anyway, so overall, I think it looks decent. I would expect it to be around a 10% return personally. So those are my thoughts, Bernard, on PFG. And then Michael wanted to look at GLW, Corning. Now, this is not Owens Corning. This is not Owens Corning, which is the fiberglass insulation maker. This is the Corning company that it's in the information technology sector, electronic components. It makes a lot of stuff with glass, like for iPhones and fiber optic cables and things along those lines. They have something called Gorilla Glass too, I believe, which is supposed to be like state of the art for them. Their dividend growth was 0 since 2023. That doesn't look good. What are they doing? Yeah, they haven't grown it since 2023. And they didn't grow it much between there. Let's see if we can figure this out a little bit. Dividend safety is about a 77. They were up 5% today. That's impressive. Triple B plus. So they got a relatively good credit rating. Let's take a look and see. Let's look at some of the financial numbers. The earnings payout ratio is falling. So by holding their dividend flat, what I think this is what they're saying, and this would be, I give a lot of respect to them for this. So I don't I'm not saying that they are doing anything bad here. I'm just saying that I think this may be a good way to manage the business. They are saying that by holding the dividend flat for the last few years, earnings are going up. Let's see if we can, yeah, see that? So over the last few years, it's going up. It's gone from $1.70 in 2023 to $3.09 in 2020 next year, 2026, right? So what that means is that they have held the dividend flat, but the earnings are growing, and therefore the earnings payout ratio is getting back into a reasonable area. So it's getting back down. The next year, it's going to be back down in that mid 30% range. I think that's a good play. That means that they're getting to keep more of every dollar that they earn, so they can reinvest that in the business. Um, but it does kind of mess up our model a little bit. So that's probably, I do have it in the model. We'll go there in a minute, but I think that's probably why it doesn't score very well, is because they're kind of repositioning the company from a capital perspective, a capital allocation perspective. So it kind of causes things to get a little wonky when they do that. But I have a lot of respect for them for doing that. I think that's a good thing to do. All right, let's take a look at sales. Sales are going up. That's good. Return on invested capital is around 8%. It's not like setting the world on fire. Net debt to capital is around 41%. They do have only a 6.92 interest coverage ratio. So that might be something to keep an eye on, is that they have a pretty good level of debt compared to their earnings. So let's let's take a look and see what Morningstar says their valuation is. It says it's a 1 star, meaning that it's trading at a 58% premium. What that means is they're saying, they being Morningstar, and their last update was on January 28th. So about a month ago, maybe a little over a month, 5 weeks ago, they said, "Hey, our fair value." Actually, January 27th is when they came up with the fair value. They said $95. It's trading at 150. So you're basically paying $150 for a $95 stock. Is what they're saying. Now, whether you believe that is their fair value or not is a whole different question. But it's better than what I could come up with. So that's then probably why it's not performing well in the model. But let's go and take a look. Let's do this, and we will do a search for GLW, Corning Incorporated. There we go. So I do not own Corning. It is it is the very last rated stock in the portfolio. My model says that it's going to have a negative 9% return. Analysts are saying it's going to have a negative 19% return. It has a narrow moat. It's trading at, as we just saw, 166% of its fair value. Return on invested capital is not very impressive. It's only at 8% with a high uncertainty rating. Dividend safety is 77. Payout ratio is 44, but heading down back into those mid 30s, like we talked about here in the future. Dividend yield is very low at 0.7%. They bought back a little bit of shares, but not a tremendous amount. So yeah, I don't know. It just it's actually, to be honest, it is here. Let me open this back up. It is the very last stock in this whole model. So it's even behind Walmart. So I don't know, man. So, Michael, it's I love their product. I think they have a great product. I think it may be just overvalued, and yeah, I don't know. Let's kind of catch up with some of the comments. Maybe you guys are saying something different. Let's see. Yeah, so it's a five bagger, man. It must have really been doing well. We already saw that. Oh, yeah, TPL's a one bagger. There you go. So Suzuki Man, hey, welcome to the program, man. I appreciate the messages a little bit earlier, but let's say I bought GLW in 2022, so you've done pretty well, I think, in that. Since they make that Gorilla Glass, yeah, it's a good product. I mean, it's always good to have something that other people want that nobody else can make, right? That's not a bad place to be. Michael bought it in 2021, so that's good stuff. Um, Yeah, GLW just got a huge $5 billion fiber optics deal with Meta. Do you know if that happened before the 27th of January? And should we expect any kind of valuation change from Morningstar? I had some kind of hair on my mic. From Morningstar on that. That might change things a bit. Um, yeah, so that's the only thing I can think of. Let's take a look real quick again at their sales, the sales numbers. Total sales 15.6 billion. So yeah, if they got 5 billion, that would be about 33% of their revenues. So if it happened on January 28th. Yeah, that dropped my pen. That could be a game changer because this valuation was done on the 27th. Let's see if they say anything here about AI growth potential. I don't see anything right offhand that says that they've captured this deal with Meta in their valuation. But I don't know why they wouldn't have updated it already. It's been 5 weeks, right? I mean, does anybody disagree with that? So they are trading at 157. So let's just say we can't do it this way, but let's pretend. All right. Let's just pretend that if it is 33% of revenues and their margins are somewhere in the, what did they say? Operating margins around 15%. So if we were to say 5 billion times, which is one third of their revenues at a 15% return, that's going to get, some number. And that number would then add to the valuation of Corning. But I still think it would struggle to get from $95 to $157 just on that business alone. But it went up 5% today. So I don't know. I think, at least from my perspective, I think I've missed the boat on this. I'm not inclined to invest in it. If I owned it, I don't think I would sell it. I think I would hold on to it. And, it sounds like they are really doing, the management team seems to be working very hard and doing the right thing for shareholders. So I would just hold on to it. I don't think I'm going to buy it at these levels, but I wouldn't. I don't think I would sell it if I had it here. All right. So whatever. What else do you guys want to take a look at today? We've got a few minutes here. Anything popping your fancy there? There was no Russ. Yeah, I don't know what happened to Russ. I was waiting for the little notification to jump on his show, and he was not there. So yes, Steve, I will be happy to do that. I don't want you guys to lose out on the opportunity to see the Simply Safe dividend news. So here we go. Let's take a look. We'll go to the latest. And today's the second. So last week would have been somewhere in the, I don't know. We'll just start right. Well, 26 was a big day. So let's take the 26th. Look how many things happened on the 26th. We can't pass that up. Okay. Amgen got an updated outlook. It doesn't look like they changed anything though. Dividend safety is 74. PSEG, Pacific, I think that's Pacific. Maybe, I don't know. Maybe I'm wrong. Oh, New Jersey. Yeah, PSEG out of New Jersey. They raised their dividend by 6.3%. That's pretty good. 15th consecutive annual increase. Went from 63 cents to 67 cents per quarter. With a 99 dividend safety rating. I might have to add them to the model. I've got a few utilities in there, but not a lot. I may need to add PSEG into the model. Here, I'll write that down. See how it fares. Okay, we have EPR. I'm not even sure what that is. EPR Properties. It's a REIT, and they have a 50 borderline safety rating. But they grew the dividend by 5.1%. It's the fourth straight year of increases. Man, that was since 2022. Double B plus credit rating. So that means that they're a junk status in terms of credit rating. So, yeah, something I wouldn't be interested in. Sempra is another utility. It nudges its dividend 1.9% higher, just a smidge. Now, Chubb is a insurer, property and casualty insurance. They increased their payout by 5.2%. 33rd consecutive year. I actually have Chubb in the model. It's got a 99, the highest rating that Simply Safe has. Dividend yields only 1.19%, so it is not, a high yielder for some of you guys that like those high yielders. But the dividend growth is 5.2%. So you got that going for you, and let's see what they've got going on in valuation. Chubba Lubba. There we go. It was stuck. All right. Chubb is a 2-star. That means that it is trading at a 20% premium. So Chubb is Chubb's a good company. It's just going to take a while to get the return back on the investment. Robert Half, I used to own them, and I am so glad I sold them. They went from 40 to a 30. Reported first sequential revenue improvement in more than 3 years last quarter. So yeah, Robert Half is. Let's see what it's done just in. What's the ticker symbol? RHI. Let's take a look at its chart. Robert Half. I owned them probably 2 or 3 years ago. Let's take a look at their chart just to see. Invalid security. There's no way. Let's hit that again. There we go. All right, that's one day. They were down 2.8% today. Year to date, they're down 12.67%. 1 year, they're down 60%. 60% over 1 year. That is nuts. Let's take a look at a five-year chart. Yeah, I think I owned it somewhere in this 2022, 2023 range here and decided that I would just get out of it and did. It was one of those that I owned very little of. And so I was like, hey, I want to get the number of stocks that I have down. And this was one of the ones I picked to get out of. And dude, it is down almost 70% over the last 5 years. Not straight. It went up before it came down, but it's like a roller coaster. That's awful. So I feel sorry for them. I used to use them when I was in the business world. Stepan, I used to own them too. Its recovery is taking longer than expected, so they are decreasing its dividend safety by 10 points from 80 safe to 70 safe. So it's still safe, but it's a little less safe, I guess. It says their shares fell sharply on Monday. Stepan is kind of a mid-cap stock, and I held it for a while, but it just never really got any traction. And so I just moved on to other things. That's probably been about 4 years ago, though. Been a long time. CSX Railroad it raised its dividend by 7.7%. 22nd straight year of increasing payouts. That's good. So that's a nice increase. Eaton, it ups its dividend by 5.8%. Eaton is a nice company. I used to, attend some meetings at their facility there in around Cleveland, and they've got a nice company. Yeah, I don't know of anything else to say there, but Eaton looks pretty good. Dell hiked it by 20%, delivering on the goal of double-digit annual growth through 2030. Sorry. So yeah, Dell's doing well. Old Republic, as opposed to New Republic. Old Republic boosts dividend by 8.6%. So good for them. Nestle dividend remains secure despite slower growth, but they dropped it from a very safe 90 dividend safety rating to a safe 80. So if you own Nestle, that's something you may want to take a look at. Structural bread. I've never heard of that before. Oh, Flow. Yeah, I think it's Flowers. Isn't it Flowers? Yeah, Flowers Foods. It's the decline in structural bread. I thought structural bread was the company, and but I was like, no, that's FLO is Flowers, and so there it is. It's Flowers food business, which is impacted by a decline in the structural bread segment. So, yeah, Flowers dividend. So they're going from 40 to a 20, very unsafe. So if you own Flowers, take a look at that. AES agrees to go private. Wow, that's pretty cool. Below market price, says may move necessary to support growth projects. Huh. Man, the shares dropped over 15% Monday after the company announced it would be acquired in a deal that would be below market value. Wow, that's crazy. I think they're based out of St. Louis, if my memory's right. MSC industrial dividend remains sound, but coverage has tightened. So they dropped it by the dreaded 4%. points from 84 to 80, but it did take it from very safe to only safe. So there you go, Steve. There's the news, my friend. So hopefully that yeah, here it is. Hopefully that is what you needed. About RMD for the first time ever today. A CPAP, sleep apnea play that benefits from GLP. Nice fundamentals. RMD. I don't know. What is RMD? Let's take a look. Oh, ResMed. Yeah, I have that CPAP. Um, so let's take a look just real quick. Payout ratio looks fine. Last 5 years, I've grown the dividend by about 6%. They've been a pretty consistent grower of dividends. And about a 1% dividend yield. Wow, look at that earnings payout ratio. It just continues to drop lower, 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 even though it's growing the dividend by, what did it say, 6%. So that's good. Earnings per share is continually growing. This might be something cool to look at, dude. You always have these great ideas, man. Return on invested capital is around 20%. That's what we love to see. It's very healthy. Net debt to capital is 0. That means it's got more cash than it has debt. The interest coverage ratio is 2.88. 2. The interest coverage ratio is not 2.88. It's 2,880 because this is in thousands. So they're doing great. So the other thing we'll take a look at is their valuation. ResMed, it is trading a 12% discount. So what would I think about this? 7. I think this is probably around a 10, 11, 12% grower. Unless, there's something there that's going to cause them to, grow exponentially. If I were just looking at the numbers tell me that, I can count on 10, 11, 12% per year from that. So it might be worth looking into. I'm going to put that on my list here to look more into, especially since I use their product. So it's only fair for me to do that, right? Yeah, Suzuki Man says it's not a good buy-in time for GLW. I agree with you. I mean, it's a great company. It's got a great product. I just think now is not the right time. But I would not sell it if I owned it. Russ got locked in a Portillo's and he's trying to eat his way out. Poor Russ. Yeah, public service. Yeah. We used to call it PSEG, but I was thinking it was the one out on the West Coast, but it wasn't. MSI. Oh, hold on. BMI and MSI. So I don't know. I don't know what my thoughts are. BMI. Oh, Badger meter. Yeah, I have that in the model actually. And so we'll just go there. I may have MSI in there too. Let me take a look. No, I don't. Motorola. Let's look at Motorola first. Then I'll go to the model for the other one. So Motorola is fair valued according to Morningstar. Its price is $482. They say the fair value is around $475. So it's right at fair value. And if I were to look at MSI here, it's got a dividend safety rating of 61, about a yield of 1%. Their 5% growth rate's been around 11.2%, but it's pretty consistent. So I would say this would be about a 12 percenter here. Suzuki, man. I think I mean, it's not a bad stock to own based on the numbers. But I have not been following this company. I have not seen any of their earnings releases or anything like that. So I'm not sure. I don't know what they're doing now since they tanked the cell phone business. So I don't know. I'd have to look more into that, but the numbers look great. And let me look at this payout ratio. Yeah, look at that payout ratio. It's just flatter than flat, man. So you go flatter than flat on the earnings payout ratio, and you're growing your dividend by, as you can see here, 11% per year on average, 12% over the last 10 years. Then your business is growing at a pretty good clip. So I think MSI is not a bad company to look at either. Badger meter. Let's take a look real quick at Badger. Badger meter. All right, I don't own any of it, but it's got about a 19% potential return. Analysts are saying 18%. So I think the model and the analysts are pretty close to each other. Doesn't always happen that way, but it does make it nice when it is. They've got a narrow moat. They're trading at about an 8% discount with a 20% return on invested capital. They do have a high uncertainty rating, though. Dividend safety is at 94. Payout ratio it's at 31%. So, they're looking pretty good, I think. I mean, just from a numbers perspective, they look pretty good. They are number 15 on my stock list. So, if that means anything to you. So yeah, it's definitely a growth play. They've been growing at about 16% clip, pretty consistently though. So that's worthwhile. So yeah, I'm a fan of Badger Meter. I think it's a good stock to look into. Let's see if there's anything else here. Oh, thanks, Steve. You're appreciated, man. I'm glad you joined. Oh yeah, Russ says he'll tell me more about them in the Discord, and I think that's fantastic. If you are not a member of the Discord and want to be a part of that, you can certainly click on the link below, and it's free to join. So come and join us. Let's see if I don't see anything else of any note here. But hey, guys, I hope you have a great week. There's a lot of geopolitical uncertainty out there, and I hope, I'm, what's has the right way to say this. I don't get to decide whether we have geopolitical uncertainty out there, but I do like to take the opportunity when it's there to search for some things that I can make some money on in the future. So we'll be keeping an eye on that. If there's anything that stays down for any length of time, we'll be keeping an eye on that. So other than that, I'm going to let you guys go. It's been a great hour, and I appreciate you guys being here, and I will see you on the next one next week live from Alabama. We'll see you, buddy.